Hello friends, good morning. Let us start our CFNL DT revision. We are in capital gains, right? We have already discussed some of the provisions relating to capital gains in the previous session. This is a continuation of previous session. We have discussed in the previous session up to section 51. Not up to section 51. We have discussed up to section 40, section 48, section 48 subsection 3, section 48 clause 3, and section 9b, section 45 subsection 4. All these we have discussed, right? We will discuss the remaining sections. Okay, let's come to section 50b. What is section 50b? Section 50b is slump sale. Means, what is slump sale? Slump sale means any consideration that has been received on transfer of the whole of the undertaking without assigning any values to the individual assets and liabilities of the undertaking is called a slump sale. So in case of slump sale, here what is full value of consideration? We have to first see what is full value of consideration. Full value of consideration is higher of FMV1 or FMV2. What is FMV1? FMV1 is defined as A plus B plus C plus D minus L. A is what? A is the amount of other assets other than income tax paid, amount of other assets. Other assets does not include income tax paid. It does not include any unamortized balance of expenses. It does unamortized balance of expenses that do not qualify as assets. Third one is but it includes income tax refund. This is A. B is what? B is any assets, any jewelry or any work of art or painting, sculptures whose value is open market value that has been provided by the valuation officer. Next, C is what? C is any shares and securities. Any shares and securities that are listed on recognized stock exchange, whose value is determined as per Rule 11UA. Rule 11UA is C, and D is what? D is nothing but immovable property, where the stamp duty value will be taken as the value of the immovable property provided by the government authorities or valuation authorities. Value assessed or assessable by the government or valuation authorities is stamp duty value. We will take stamp duty value only in respect of D. And L is what? L is all liabilities excluding the following liabilities. Those are paid up share capital of the company and free reserves other than reserves that are allocated for distribution of for the purpose of depreciation. Means those reserves that are allocated for the purpose of depreciation, it is treated as liability and it will be included in the liabilities. Next, any reserves that have been allocated or that have been set aside for the purpose of declaration of dividend, but the dividend has not been declared, are also to be excluded from the all liabilities, and it does not include any provision relating to unascertained liabilities or any provision relating to contingent liabilities or any income tax, any provision for tax other than income tax. Means provision for income tax is treated as liability and it will be included in all liabilities, and it does not it will be included in all liabilities. So we have seen this is A plus B plus C plus D minus L. This is FMV1. Now we will go to FMV2. What is FMV2? FMV2 is E plus F plus G plus H. E plus F plus G plus H. What is E? E is, as we have already discussed, all assets. E is monetary consideration that has been received by the assessee during the previous year in case of slump sale. E. F is what? F is non-monetary consideration that has been received by the assessee during the previous year. Non-monetary consideration that has been received by the assessee during the previous year, where the value has to be taken as per the value determined, that is fair market value. And E plus F plus G. G is what? G is any money, any any jewelry or any work of art or any painting that have been received by the assessee in case of slump sale, where the value is to be determined as open market value. And F we have seen G, E plus F plus G plus H. H is what? H is any shares and securities that have been provided to the assessee in respect of slump sale, where the value of shares and securities is determined as per Rule 11 UA. FMV1 or FMV2, whichever is higher, is taken as full value of consideration. From this, we have to reduce what? We have to reduce cost of acquisition. What is cost of acquisition? Cost of acquisition is any total assets of the entity minus outside liabilities is what? Cost of acquisition. That is net worth. Net worth of the entity is cost of acquisition. Here, total assets of the entity includes total assets of the entity already we have discussed, and liabilities, what are included in liabilities, what are not included in liabilities, what already we have discussed in the above point. In case of full consideration, FMV1 value L point deals about this point only, liabilities. Then we will get net worth of the undertaking. If we deduct full value net worth of the undertaking or cost of acquisition from the full value of consideration, then we will arrive at capital gains depending upon period of holding. The period of holding is here obviously the it will fall under 36 months bucket as per 2 subsection as per 2 subsection 42 capital A. It will fall under 36 month bucket, because the period of holding type of asset is any other asset, and period of holding is more than 36 months. If it is more than 36 months, then it will be treated as long term capital asset as per 2 subsection 42 capital A, 2 subsection 42, and the gain that is arising from long term capital asset is long term capital gain as per 2 subsection 42 capital A. And when we comes to as per 2 subsection 42 capital A, now let us if the period of holding is less than 36 months, then in that situation it is short term capital asset, and any gain or loss short term capital asset has been defined under 2 subsection 24, not 2 subsection 24, it has been defined under under section 2 relevant section, it has been defined, and the gain arising from this short term capital asset is short term capital gain. Short term capital gain, it is any other short term capital gain because it is taxable at rates in force or 30% as the case may be, and in respect of long term capital asset it is taxable at the rate of 20%. There is no indexation benefit that is available in respect of slump sale, and in case of slump sale there is no indexation benefit that is available in case of slump sale. Now we will go to this is section 50B, slump sale. Now section 50C. What is section 50C? Section 50C is any consideration that has been received on the transfer of immovable property where the value where the date of agreement and date of registration are not same. If the date of agreement or date of registration are not same, then in that situation we have to take on stamp duty value and what date will be considered as full value of consideration. First, if the date of agreement is not date of agreement and date of registration is not same, or date of agreement or date of registration is same. If the date of agreement and date of registration is not same, then we have to go to whether any advance amount has been received at the time of entering into an agreement, or any whole or part of the consideration has been received by the assessee at the time of entering into an agreement. If answer to the question is yes, then in that situation the stamp duty value on the date of agreement will be considered as full value of consideration only when it is up to 110% of the if it is more than 110% of the consideration. If the stamp duty value is if the full value of consideration is more than 110% of the consideration, then we have to take the stamp duty value that is available on the If the stamp duty value is up to 110% of the consideration, then we have to take only full value of consideration as full value of consideration. Here on what date stamp duty value has been taken means depending upon the date of agreement and date of registration. If the date of agreement and date of registration are not same, or if the date of agreement and date of registration are same, then stamp duty value on the date of agreement or date of registration as the case may be will be taken. But if the date of agreement and date of registration are not same, then we have to see whether any whole or part of the consideration has been received in respect of date of registration, date of agreement, then date of agreement will be considered as full value of consideration. If any part of the amount, if nothing has been received on the date of agreement, then stamp duty value on the date of registration will be taken as full value of consideration. Here, if any reference has been made by the valuation officer, has been made by the assessing officer in respect of the value of the property to the valuation officer, and valuation officer comes with his proposal, there are two situations. First situation is the value determined by the valuation officer can be less than stamp duty value. The value determined by the valuation officer can be greater than stamp duty value. If the value determined by the valuation officer is less than stamp duty value, then the full value of consideration is value determined by the valuation officer. If the value determined by the valuation officer is greater than stamp duty value, then the full value of consideration is the stamp duty value. Stamp duty value is treated as full value of consideration. This is section 50C. Now we will go to section 43CA. Section 43CA is what? Section 43CA comes to capital profits and gains from business or profession. Under profits and gains from business or profession, we have already seen any consideration that has been received on sale of the asset, on the sale of the asset, which is now will be taxable as a will be taxable under the head profits and gains from business or profession. The same category will repeats here also. Here, if the date of agreement and date of registration are not same, or if the date of agreement and date of registration are same, and if the date of agreement is the date of agreement and date of registration are not same, if the whole or part of the amount has been received on the date of agreement, then stamp duty value on the date of agreement will be taken as full value of consideration. If nothing has been received in case of date of agreement, then the stamp duty value on the date of registration will be considered as full value of consideration. Now we will go to second category. If the date of agreement and date of registration are same, then stamp duty value on the date of agreement or date of registration as the case maybe will consider as full value of consideration. Full value of consideration. This is section 43CA. Now we will come to section 50CA. Section 50CA is what? Section 50CA is section 50CA. Section 50CA is any amount that has been received by the assessee. Section 50CA. Section 50CA is what? Section 50CA is any amount or consideration that has been received by the assessee in respect of transfer of capital asset, where section 50CA. Yeah, we will discuss the section 50CA later. We will go to section 50D. Section 50D is what? Section 50D is any consideration that has been received on transfer of unquoted shares. In respect of transfer of unquoted shares, then what are the capital gains that are going to arise, and it will section 50D deals with this. Section 50CA, section 50D we will discuss later. Section 51. Section 51 is what? Any advance money that has been received in respect of transfer of capital asset. If any advance money that has been received by the assessee, it has to be divided into two categories. So first category is if the advance money has been received before 1/4/2014, if the advance money has been received on or after 1/4/2014, if the advance money has been received before 1/4/2014, then advance money, whatever the advance money that has been received, has to be reduced from the full value of consideration. If the advance money has been received on or after 1/4/2014, then advance money has to be taxable. Advance money has to be considered as income from other sources, and it will be taxed. It will be clubbed under income from other sources. Now we will go to section 50. Section 51 we have discussed, and we will go to we will go to some special assets that have been transferred during the previous year. Here the special assets are relating to that is long term 111A, 112A, 112, 112. 111A is section 112 capital A. 112 capital A is what? 112 capital A is any long term capital gain that is arising from the transfer of equity shares or equity oriented mutual funds, whether listed or not listed. Equity shares whether listed or not listed, equity oriented mutual funds whether listed, and units of business trust. Here STT has to be paid at the time of both sale and purchase in case of listed equity shares and listed equity oriented mutual funds. STT has to be paid both in case of transfer. Next, in case of units of business trust, STT has to be paid. Here STT, whatever the STT has been paid will not be allowed as deduction in case of capital gains, but whatever the STT has been paid will be allowed as deduction under 36 subsection 1. 36 subsection 1. You remember 36 subsection 1, clause 14 or clause 15? Clause 14, clause 15. Clause 15 or clause 15, I think so. No, clause 17, clause 18. Clause 18, that is securities transaction tax and commodity transaction tax that has been paid by the assessee will be allowed as reduction from the PGBP income. Now we will come to normal category. Here, whatever the capital gain, whatever the assets that have been transferred, whatever the consideration that has been received here. What is full value of consideration? Full value of consideration is what? Full value of consideration is determined as follows. That is higher of the consideration, the value that has been determined under the 31/1/2008, and the consideration, cost of acquisition consideration that has been received here. The value that has been determined on under 31/1/2018 is 31/1/2018 is lower of the following. That is the value on 31/1/2018 on 31/1/2018 or cost of acquisition. Here if the shares are listed on recognized stock exchange, then average of opening price or closing price, opening and closing price will be average of opening and closing price will be taken as the value. If the shares are not listed on recognized stock exchange, the shares are not listed on recognized stock exchange. Any date which is closer to, if it is not a trading day, any date which is closer to the transfer date will be considered, and the opening value and closing value highest divided by 2, the average of opening and closing price will be taken as value. And if the shares are listed on more than one stock exchange, then the stock exchange that records highest turnover will be considered, and the value that is the average value of opening and closing prices in the stock exchange will be considered for the purpose of determination of value on 31/1/2018. And cost of acquisition, we have to, whichever is higher and whichever is lower, and here sale consideration or the value determined here, whichever is higher will be taken as full value of consideration. From that we have to reduce cost of acquisition. We will get capital gains in respect of section 115A. Section 112A, whatever the capital gains that are arising under section 112A, out of this up to 1 lakh rupees, no capital gain tax will be levied. If it exceeds 1 lakh rupees, on excess amount only capital gain tax is levied at the rate of 10% concessional rate. Because why the government has provided 10% concessional rate means SSC has provided securities transaction tax. So the government will tax in order to encourage equity investments or investments in mutual funds and investments in mutual funds. The government has provided concessional tax rate at the rate of 10% in respect of capital gain arising under this category. Next we will go to section 112A. Section 112. Section 112 is long-term capital gain arising from the transfer of capital asset. Section 112. Here, capital asset includes any other capital asset, not excluding listed equity, securities and shares. Here, in respect of all type of persons, whether it is person definition has been defined under section 31. So, all type of persons will be considered here. If the period of holding is depending upon the period of holding, it is long-term capital gain, right? Period of holding will be greater than or equal to 24 months or greater than or equal to 36 months. Greater than 24 months, greater than 36 months. Period of holding, then it is long-term capital asset. Then long-term capital gain will be taxed at the rate of 20%. And in respect of zero coupon bonds, here long-term capital gain will be taxed as what? Long-term capital gain will be taxed as 20% without indexation or 10% with indexation. 20% without 10% without 20% without indexation and 10% with indexation will be charged in respect of zero any gain arising from zero coupon bonds, redemption of zero coupon bonds or repurchase of zero coupon bonds. Next we will go to section 111A. Section 111A is any short-term capital gain arising from transfer of listed equity shares or listed equity oriented mutual funds or units of business trust. Here any STT that has been paid at the time of both purchase and sale will be STT will be paid in respect of listed equity shares. In respect of listed equity oriented mutual funds, STT will be paid at the time of transfer, and in case of units of business trust, STT will be paid at the time of transfer. Here from the here full value of consideration is a consideration that has been received by the SSC on transfer of listed equity shares, listed equity oriented mutual funds and units of business trust. From that we will reduce cost of acquisition, then we will get capital gain. It will be taxed at the rate of 15%, concessional rate of 15%, as it is falls under 111A category. It falls under 111A category. All other securities will be taxed at the rate of 30%. Short-term capital gain will be taxed at the rate of 30%. Now we will go to Here one beautiful points you have to remember here is first thing is here in respect of 112a, in respect of 112a, unexpired basic exemption limit can be allowed to set off. Unexpired basic exemption limit adjustment is allowed, but rebate under 87A is not allowed under section 112A, and under section 112 also unexpired basic exemption limit is allowed, adjustment is allowed, but rebate under 87A is not allowed. Under section 111A also unexpired basic exemption limit allowed, unexpired basic exemption limit adjustment is allowed, but deduction what is not allowed is not allowed category is what? Not allowed category is debate under 87A is not allowed, and in respect of in all these categories, that is section 111A, 112, 112A and dividend, the maximum surcharge rate that is applicable is 15% only for this category of incomes, and here for this category of income. So this is section special category of assets, that is section 112A, 112 and 111A. Now we will go to section 54 series, section 48. We will go for section 48. Section 48, what is section 48? Section 48 is a computation of capital gain. How we have to compute capital gain? Here under section 48 clause 1 deals with any computation of capital gain in respect of non-resident. In respect of non-resident, how the capital gain has to be computed. In respect of non-resident, section 40 first proviso to section 48 clause, sorry, so not section 48, so clause 1. It is section 48 clause 1 is how we have to calculate capital gain. We will take full value of consideration. From that we will reduce any expenses that have been incurred directly in respect of full value of consideration, or in respect of receiving a full value of consideration. We will get net consideration. From that we will reduce cost of acquisition or indexed cost of acquisition. Any cost of improvement has been incurred by the assessee, cost of improvement and indexed cost of improvement, and we will get capital gain depending upon the nature of the capital gain. It can be long-term capital gain or it can be short-term capital gain. So this is the procedure of computation. Exception to this is there are totally seven exceptions that have been provided under the Act, which is exceptions to normal procedure. Normal procedure is what? Normal procedure is the procedure that we have just discussed before is normal procedure. Under section 48. First proviso to section 48 subsection 1. Section 48 subsection 1 is what? Section 48 subsection 1 is in respect of long-term capital gain arising in respect of non-resident. If non-resident transfers any capital asset that is denominated in foreign currency, then how the capital gain will be calculated? Here for full value of consideration has to be converted into Indian rupees by taking TTBR or TTSR, average of TTBR or TTSR at the time of transfer. At the time of transfer, what is the TTBR TTSR? We have to take average of TTBR and TTSR, and any expenses that have been incurred by the assessee, we have to take average of TTBR or TTSR at the time of transfer, and cost of acquisition is what? Cost of acquisition is also we have to take TTBR, convert into Indian rupees, so that is TTBR or TTSR divided by 2. Then we will take full value of consideration in Indian rupees, and we will reduce the transfer expenses in Indian rupees, and we will get net consideration. From net consideration we will reduce from net consideration we will reduce cost of acquisition in Indian rupees. We will get capital gains. This capital gains has to be reconverted into TTBR at the time of transfer. Then we will get capital gains. We will get capital gains here. Not in Indian rupees, in foreign currency. In foreign currency, we will get capital gains. The capital gain that is arising in foreign currency will be reconverted into Indian rupees by taking TTBR at the time of transfer. Then we will get capital gains in Indian rupees, and depending upon the nature of capital gain, it will be taxed accordingly. Short-term capital gain or long-term capital gain, as the case may be. And here this is the procedure that have been provided under section 115A. Now we will go to section for second proviso to section 48 subsection 1. Second proviso is what? Second proviso is relating to indexation. That is indexation benefit. Indexation, to whom indexation is applicable? Indexation is applicable for all category of assets, but indexation is not applicable for some category of assets. Indexation relating to cost of acquisition, indexation relating to cost of improvement. If indexation is related to cost of acquisition, that is cost of acquisition into cost inflation index number at the time of transfer divided by cost inflation index number at the time of purchase. And here in case of cost of improvement, cost inflation index number at the time of transfer divided by cost inflation index number at the time of cost of improvement, we will take into consideration, and we will get indexed cost of acquisition and indexed cost of improvement, and this indexation benefit is not applicable in respect of debentures, and debentures with the listed or listed or unlisted, indexation benefit is not available, unless and bonds, unless capital indexed bonds, for capital indexed bonds, indexation benefit is available, and indexation benefit is not available in respect of in respect of depreciable assets, indexation benefit is not available, and indexation benefit is not available, and this is second provision to section 48 subsection 1. Next, third provision to section 48 subsection 1. Third provision to section 48 subsection 1 is, and third provision, fourth provision, fifth provision, sixth provision, seventh provision. So there are totally 5 projects remaining. We will discuss later, and this is section 40. We will discuss later, and now we will shift to what? We will shift to section 54. Section 54 is what? Section 54 is relating to exemptions that are available in respect of a capital case. What are the exemptions that are available? This has been divided into the following categories. First category is in respect of individual NHF, in respect of others, in respect of any person, in respect of individual NHF. Those exemptions that are available are section 54, section 54G, section 54B, section 54GB, and section 54G, section 54GB, and section 54F, section 54F. These 4 are related to only individual NHF. Next, other category of exemptions that are available for any person is section 54. Section 54F, section 54EC, section 54G, section 54GA, and section 54GA. These 4 deductions are available, exemptions are available in respect of any other person, and depending upon long-term capital asset or long-term capital asset or short-term capital asset, if it is purely long-term capital asset only, section 54 is available, section 54B, section 54 is available, section 54F. Section 54F is available, section 54G is available, GB is available, and section 54 section 54GB is available. If it is long-term capital asset or short-term capital asset, remaining sections will be either it is long-term capital asset or short-term capital asset. Now we will go to section 54. Section 54 is what? Section 54 is any capital gain arising on in respect of transfer of long-term capital asset where investment has to be made in one residential house property. Here assessee has to make investment in one residential house property. Here, what is residential house property? In one of the court decisions, it has been mentioned that it is residential property. Residential property can include many residential units. Not a single residential unit. It can be include many residential units. All the residential units within the residential property will be considered as a residential property. A residential property can include residential property. So who is a person? It is applicable for only individual NHF. And what is the type of capital? The type of capital is long-term capital asset. And what is the investment that has to be made? Investment has to be made in residential house property. What is the time limit within which investment has to be made? Investment has to be made within 1 year before, or 2 years after, or 3 years after the date of transfer, or 3 years within 3 years of construction has to be completed after the date of transfer. So here some of the cases that are relating to this is if it is to 1 year before, if it is 1 year before. The assessee has acquired assessee has made investment in the residential house property 1 year before, but here the thing is assessee has not utilized the funds that are received from the sale consideration, because 1 year before the date of transfer there will be no transfer took place, and assessee has utilized his own funds. Whether the exemption under section 54 is available or not, court has declared that the exemption under section 54 is available. Next, in respect of 3 years after construction, 3 years after the date of transfer, construction has to be completed. If the assessee could not complete the construction within the period of 3 years from the date of transfer, then if there are minor work that are pending relating to flooring or relating to interior decoration or interior work or interior decoration or flooring, then whether exemption under section 54 is available or it will be not available. As a court has declared that section 54 exemption under section 54 is available, and so here what is capital gain, whether capital gain account scheme is available? Yes, capital gain account scheme is available. The person has to deposit the sale consideration that has been received in capital gain account scheme. Capital gain account scheme. Next, once he has deposited the amount in a capital gain account scheme, then we will go to then what is the amount of exemption that is available. That is either capital gain or cost of new asset or capital gain that has been received or amount deposited or cost of new asset, whichever is lower will be allowed as exemption. And assessee should not transfer the asset within a period of 3 years. If the assessee has transferred, there is a lock-in period of 3 years. If the assessee has transferred the asset within a period of 3 years, then whatever the exemption that has whatever the exemption that has been provided to the assessee will be withdrawn, and it will be taxed in the year in which capital gain exempted will be taxed in the year in which asset has been transferred. Amount of sale consideration minus amount that has been exempted, remaining will be amount of investment minus amount that has been exempted. Remaining will be remaining will be taxed in the year in which the transfer took place. Next we will go to section 54B. Section 54B we have already discussed this one. That is a compulsory acquisition of rural agricultural land. If it is rural agricultural land compulsory acquisition, then it is exempt under 10 section 37. Here what is rural agricultural land? We have already discussed. Rural agricultural land means the land that is used. Agricultural land is related to rural agricultural land or urban agricultural land. Rural agricultural land means the land that has been utilized for the purpose of agriculture by the assessee or by any other person for a period of 2 years or more before the date of transfer. Then it is considered as rural agricultural land. If it is what is urban agricultural land? Urban agricultural land means it has been defined under the Act. If the land that is situated within the municipality or cantonment board of the population more than 10,000, more than or equal to 10,000, but less than more than 10,000 but less than 1 lakh, then up to 2 kilometers from the municipality limits. If it is more than 10,000, more than 1 lakh, more than 1 lakh but less than or equal to 10 lakh, it is up to 6 kilometers from the municipality limits. And if it is more than 10 lakh, it is up to 8 kilometers from the municipality limits, will be considered as urban agricultural land. In case of urban, otherwise it is considered as remaining all will be considered as rural agricultural land. And in respect of urban agricultural land, if the urban agricultural land has been compulsory acquired or it has been transferred, then exemption is not available, and it will be taxable under the head capital gains depending upon it will be taxable under the capital gains. Now we will come to section 54B. Section 54B is applicable for individual and HUF, and it should be long-term capital asset that has been transferred. Long-term capital asset or short-term capital asset that has been transferred, and amount has to be invested in what? Amount has to be invested in agricultural land only, and this agricultural land has to be utilized for the purpose of agriculture 2 years or more before the date of transfer. And what is the date within which investment has to be made? Investment has to be made within a period of 2 years from the date of transfer. And whether capital gain account scheme is applicable? Yes, it is applicable. And what is the exemption that is available? Exemption that is available is what is the exemption that is available? Exemption that is available is cost of new asset or capital gain. Capital gain amount deposit, whichever is lower, will be allowed as a exemption. And if there is a lock-in period of 3 years that is available in respect of asset that has been purchased. If the asset has been transferred before the lock-in period, then it will be taxed under the head capital gains in the year of transfer. It will be taxed under the head capital gains. Now we will go to section 54F. Section 54F is what? Section 54F is here investment in capital gain that has been received on transfer of any other asset, and investment has been made in residential house property. Here in respect of section 54 and section 54, here section 54 deals with only residential asset that has to be transferred is residential house property, and investment has to be made in residential house property. But in case of section 54F, asset can be any other asset. Any asset can be transferred, but investment has to be made in residential property only. Here in respect of section 54, here assessee should not in order to claim exemption under section 54F, assessee should not own more than 2 assets at any time during the previous year. And if he has utilized, means he can he can avail the benefit of exemption and for two residential house properties under section 54 he can utilize he can avail the benefit of exemption for two residential house properties, but it is only one option that is available for as a lifetime. In the lifetime he can only utilize to claim exemption of two residential house investment into two residential house properties and it is not available anymore if he has utilized the option for the first time in his lifetime. Now we will go to section 54F. Under section 54F, he should not own more than one residential house properties at any time during the previous year, and transfer asset that has been transferred is any other asset. This is applicable for only individual and HF. Any other asset that can be transferred, and investment has to be made in residential house property and residential house property. And here asset is long-term capital asset, and what is long-term capital asset or short-term capital asset, and what is the amount, what is the time limit within which amount has to be made, amount has to be deposited, amount has to be invested within a time period of 1 year before, or 2 years after the date of transfer, or 3 years after the date of construction. And here what is the capital gain account scheme is applicable, and what is here capital gain account scheme is applicable, and what is the amount of exemption that is available. Amount deposited or capital gain or cost of new asset, whichever is lower, will be allowed as exemption. And if the asset is transferred within a period of 3 years from the date of transfer, within a period of 3 years from the date of availing exemption, then the exemption that has been availed will be lapsed and it will be taxable under here capital gains. Now we will go to section 54GB. Section 54GB is what section 54GB is. Asset transfer is any other asset, but investment in equity shares of the startup, eligible startup. What is eligible company and what is eligible startup? Eligible company means a company which has been incorporated for the purpose of manufacture or production of article or thing, or for the purpose of technology, and the company has utilized its proceeds, sale proceeds for the purpose of subscribing or investing in the shares of the eligible startup. Here, what is eligible startup? Eligible startup means a startup which has been incorporated on or after 1/4/2016 and to 31/3/2024, and eligible startup has obtained the certificate from the IMBC, interministerial IMBC, and here the thing is here eligible startup should be established for the purpose of production or manufacturing of any article or thing, or in order to invent any new technology, or invent any new article, or discovery of any technology, it will be obviously eligible startup that are eligible for the purpose of exemption under section 54GB, and investment can be made. Investment has to be, what is the time limit within which investment has to be made? Investment has to be made within a period of 1 year from the date of transfer, and what are the 1 year from the date of transfer, and capital gain account scheme is not applicable. And here what is the exemption that is available? Investment that has been made or capital gain which is lower will be allowed as exemption, and if the securities are sold within a period of 3 years, then in the date of transfer it will be taxable as capital exemption, will be taxable as capital gains. Now we will go to section 54D. Section 54D is what? Section 54D is transfer of land or building, or in section 54D is this is applicable to any other person, any amount, any consideration that has been received on transfer of any other asset, but investment has to be made in industrial undertaking, land or building, or both of industrial undertaking, section 54D. Here asset that has been transferred is long-term capital asset or short-term capital asset, and long-term capital asset only, and investment has to be made in land and building of industrial undertaking, and what is the time limit within which investment has to be made? Investment has to be made 1 year before, or 2 years after, or 3 years after the date of transfer. 1 year before or 2 years after, and here amount capital gain account scheme is not applicable, and investment has to be made in new plant and machinery only, new asset and new plant and machinery only, and for shifting of under section 54B, section 54D is applicable on shifting of the factory from urban area to rural area. Any rural area, any applicant that is arising from this will be allowed as exemption. Section 54 EC, section 54 EC we have already discussed in the previous class, in the previous session. So section 54 EC. Next, section 54 G. Section 54 G is what? Section 54 G is section 54G and section 54GA. So in this section 54G is investment in the plant and machinery of the industrial undertaking. In the section 54G, section 54G is applicable. Section 54GB, section 54GA, section 54GA is what? Section 54GA is, let's see one thing, because we will see. Section 54 section 54D is compulsory acquisition of industrial, okay, compulsory acquisition. Section 54D is compulsory acquisition of land or building of industrial undertaking. Section 54G, section 54 G is shifting of the industrial undertaking from urban areas to rural areas. Section 54GA is shifting of industrial undertaking from urban areas to special economic zone. Special economic zone is section 54 GA. Section 54 GB we have already discussed, and here investment has to be made in the new plant and machinery only. Whatever the investment that has been made in new plant and machinery, it will be allowed as exemption. And if these assets have been sold or transferred, then in the year of transfer it will be taxable as capital gains. It will be taxable as capital gains, and these it will be taxable as what? It will be taxable as capital gains in the year of transfer. In the year of transfer, it will be taxable as 54 GB. We have discussed already 54 GB and 54G 3 years after. And for all these three categories, similar only. All these three are similar only. Section 54D, section 54G and section 54GA are similar. Now we will go to the remaining sections. Section 54 series, this is section 54 series. Section 54 series completed. Section 54 series is completed. Now we will go to the left out sections. What are left out sections? Left out points are section 47. Section 47 series. Section 47, whatever the transaction that is falling under section 47 will be not be considered as transfer, and no capital gain will be arised. No capital gain arised in respect of transfer that is falling under section 47. Now we will go to side pocketing or segregated portfolio or side pocketing. This is applicable in respect of mutual funds. Mutual funds that are considered as that have incurred bad debts. Mutual funds that are not incurred bad debts. The mutual funds that have incurred bad debts, then the units that are allocated, the units that are attributable to the bad debts will be segregated as side pocketed separately, and once bad debts have been realized, the units are allowed to redeem, and in respect of other units, they will be separate treatment for that. Here, in respect of cost of acquisition of units in case of segregated portfolio is cost of units in respect of total portfolio into cost of acquisition net assets value of transfer to segregated portfolio divided by net assets value of total portfolio before segregation is cost of acquisition of units of total portfolio. Cost of acquisition of units of segregated portfolio. From the redemption value of units, we will reduce cost of acquisition of the units of segregated portfolio. Then we will get capital gain that will be available. Capital gain that will be available here. Next, in respect of section 50 CA, we have seen. Section 50 CA is fair market value of unquoted shares, which will be treated as full value of consideration. When the unquoted shares are being the capital asset transferred for a consideration lower than the fair market value, then the fair market value shall be deemed to be full value of consideration. Section 50 CA. Now section 50D is what? Section 50D is where the sale consideration is not ascertainable or cannot be determined, then the fair market value of such asset on the date of transfer shall be full value of consideration. Fair market value on the date will be full value of consideration. If it is not ascertainable, fair market value on the date of transfer will be full value of consideration. Now section 50 CA 50D. Now we have already discussed the remaining all categories, and section 48 series we have to go. We have missed out some of the points in respect of section 48. let's just wait. I will look at the remaining points of section 48. Section 48. Yeah, section 48. We have discussed section 48 first provision to section 48, second provision to section 48, subsection 1, and third provision is what? First provision we have seen in respect of non-resident, and second provision is relating to what? Relating to indexation, and third provision is what? Third provision is first provision, second provision is not applicable for the computation of long-term capital gain in case of equity shares and equity-oriented mutual funds and units of business trust referred under 112A. Means here in respect of equity shares and equity-oriented mutual funds and units of business trust located under first provision is not applicable, second provision is not applicable. Means first provision is related to non-resident, means computation will be not as per the method that has been described under first provision. Second provision is indexation. Indexation is not applicable. Indexation benefit is not available. We have seen what we have seen. Indexation benefit is not applicable. Means indexation is also not applicable for listed equity shares and listed equity oriented mutual funds and units of business trust, because why indexation benefit is not available means these are taxed at a concessional rate of 10%. How why the government will again provide indexation benefit? Indexation benefit is not available. Next, fourth provision is no indexation in case of debentures and bonds. No, obviously we have discussed indexation will not be available in respect of debentures and bonds except capital indexed bonds. Capital indexed bonds or capital indexed bonds and sovereign gold bonds issued by the Reserve Bank of India. No capital gain will arise in case of individual on redemption of sovereign gold bonds issued by the Reserve Bank of India. Next, individual redemption on maturity is no capital gain under due to section 47, and transfer before maturity capital gain arises. Next, other cases capital gain applicable on the transfer or maturity and indexation benefit is available. Next, fifth provision to section 48. What is fifth provision? Fifth provision is foreign exchange fluctuation gain. Foreign exchange fluctuation gain on rupee denominated bonds in case of non-resident. Any gain, any foreign exchange fluctuation gain arising on a transfer of rupee denominated bonds in respect of non-resident will be ignored. It should not be considered. This is fifth provision to section 48. Next, sixth provision is what? Sixth provision is section as per section 47. It will not be considered as transfer. Seventh provision is what? Seventh provision is security transaction tax will not be allowed as security transaction tax will not be allowed as reduction in respect of capital gains, but it will be allowed as reduction under section 36 in respect of profit and gains from business or profession. Whether the security, if it is paid at the time of sale, it will not be reduced from the full value of consideration. If it is paid at the time of purchase, it will not be added to cost of acquisition. Next, section 55 is cost of improvement. We have already discussed cost of improvement. In case of cost of acquisition in self-generated goodwill is nil, purchase goodwill is purchase price, and with this and all we have already discussed section 55, and obviously we have discussed all the important points and some of the decisions that have been already. Will give one reading of all the important judgments. In case of C. Haryana Sundaram, section 54 does not mention the construction that the construction could not be commenced before the date of transfer of asset. Also, section 54 does not contemplate that the same money received from the sale of a residential house should be utilized in the acquisition of new residential house. Cost of purchase of land or cost of construction of residential house thereon incurred by the assessee prior to the transfer of previously owned residential property will qualify as exemption under section 54. We have already discussed. And Geeta Dukkal case, what is on section 54 and section 54F use the expression residential house and not residential unit. Section 54 and section 54F requires the assessee to acquire a residential house. The only requirement is that it should be utilized for residential purpose but not for commercial purpose. For the fact that the residential house consists of several independent units cannot restrict exemption under section 54 and section 54F, because residential concept is applicable only for section 54 and section 54F. So the assessee is entitled for exemption of capital gains in respect of investment in the residential house comprising of individual residential units handed over to the assessee. Now we will go to section Syed Ali Adil case. where the assessee has acquired two adjacent flats and has affected modification to make them a single flat for opening the door between them. It is immaterial that flat was acquired from two different sellers or two different sale dates. Both flats shall be considered as a single house property for the purpose of exemption under section 54. In respect of Gurnam Singh case, that is exemption under section 54B cannot be denied solely on the ground that the new agricultural land purchased is not wholly out of owned by the assessee and owned by his assessee son as a co-owner. Next, Kamal Bahal case, that is having regard to the rule of purposive construction and object of enactment of section 54F, exemption under section 54F cannot be denied solely on the ground that the new residential house is purchased by the assessee exhaustively in the name of his wife. If it is purchased, even though it is purchased in the name of his wife, exemption under section 54F is available. Next, Ravindra Kumar Arora case, where the house property is registered in the joint names, exemption under 54F can be allowed fully to the co-owner who has paid whole of the purchase consideration, and it will not be restricted to his share of house property. Even if he is paid full value of consideration, then exemption under section 54F is available fully for not restricted to up to his share in the house property. Next, Sambandham Uday Kumar case, exemption under 54F cannot be denied irrespective of investment made in the construction of a residential house on the ground that construction was not completed within 3 years after the date of transfer took place on the account of pendency of certain finishing work like flooring, electrical fittings of door shutter, etc. Exemption will be available under 54F. Next, VS Dempo case, Dempo Company Limited case, Section 50 deems to be capital gain as short-term capital gain. It does not change the nature of asset that has been held. Section 54 EC requires the nature of asset to be long-term capital asset, not short-term capital gain. It makes a distinction between the depreciable and non-depreciable assets, where the depreciable asset was held for the period received for the qualifying as the capital long-term capital asset. Assessee should be eligible for exemption under Section 54 EC, irrespective of the fact that the resulting gains is short-term capital gain. Next, Gauli Mahadevappa case, where the stamp duty value under 50C has been adopted as full value of consideration. Then the reinvestment made in acquiring of any reinvestment that has been made in acquiring of the residential property which is not in excess of the actual net sale consideration can be considered for the purpose of computation of capital gain. Exemption under section 54F irrespective of the source of funds for such reinvestment. Hindustan Unilever Limited, in the case of Hindustan Unilever Limited, if the assessee has made the payment for purchase of bonds within 6 months from the date of transfer, section 54 EC cannot be denied merely because the bond was allotted after the date of expiry of 6 months. Fiber Boards Private Limited, advance given for purchase of land, building, plant and machinery, and amount to be utilized to utilization of capital gain for the purchase of acquisition of new assets for claim of exemption under section 54G or section 54GA. So this closes the chapter capital gains. We have already discussed important provisions relating to capital gain. All important provisions exhaustively we have discussed in respect of capital gains, starting from section 45 to section 54. And now we'll go to next chapter, that is profits and gains from business or profession, in the latter sessions. That's all for today. Closing off. Thank you.